Let's summarize Chapter 10. First, we looked at how we determine if cash flows are relevant or irrelevant to the capital budgeting decision. Everything is relevant except for two things. The first thing that's irrelevant is a so-called sunk cost. You can simply think about the timing. If it's something that has already been paid in the past, before the decision on the project, accept or reject, is made, then it's irrelevant. The second example of an irrelevant cash flow is a so-called financing cost. That's anything related to a loan, like making loan payments. We treat them as irrelevant because they're not operating expenses. You can also say that they are kind of optional. Also, something we're going to see in later chapters is any loan is typically reflected in the discount rate. What are the three components of the total cash flow for each year? That's the operating cash flow, the net capital spending, and the change in net working capital. What is operating cash flow? It's pretty much the same thing as profit from selling whatever it is that we would be selling under this project. So this is similar to what accountants calculate in an income statement, the bottom line, net income, except in finance we also add depreciation back to it, and that's how we find the operating cash flow, because depreciation is not a true expense. So we add it back to net income in order to correctly calculate the profit made for that year. What does net capital spending include? Typically, it's initial investment that we find for year zero, and that's usually given, and the after-tax salvage value that we find for the final year of our project. So that's the sale proceeds. What is the difference between net working capital and the change in net working capital? And which one do we include in total cash flow for each year? Net working capital is like things like cash that's set aside to cover any unforeseen expenses related to the future project. It also includes things like inventory, accounts payable, accounts receivable. However, it's the change in net working capital that we are interested in, because this is what reflects the incremental cash flow, the additional investment towards the project.